puts money into a bank account and starts some sort of a business. That for accounting purposes, we're going to separate the economic activities of that individual outside the business from those activities of the business itself. And so the cash on the balance sheet of the business is not going to show all the cash that the owner has or possesses. It's only going to show the cash that is that has been devoted to that particular business. The going concern assumption is an assumption that the entity will continue to operate indefinitely. Now, what this does is it implies certain things about how we value assets. It, for instance, justifies depreciation and amortization of long-lived or long-lived assets. We don't. We know they're going to be used up. They're going to be, but we would not expense those immediately because we believe, or we have assumed rather, that in fact the company is going to continue in operation. Let me give an example of how you might have instead of a going concern assumption, you might make what's called a quitting concern assumption. Let's say that you've got a shoe factory, and at the end of the year, December 31, when the machinery is turned off for everyone to go home at the end of the day, that you've got an assembly line that has on one end, the very beginning of it, maybe some leather that has just been cut into certain shapes. Nothing else has been done to it. At the other end, you've got some shoes that are maybe through with everything but the laces having been put in. And all in between, you've got shoes in different stages of completion. Well, under the going concern assumption, we would value those shoes, those partially completed shoes, at whatever cost had been applied to them. Materials, labor, overhead, costs. If we were instead adopting the alternative, which was a quitting concern, we would have to value those partially completed shoes probably at zero. See, under the going concern assumption, nobody's going to buy half of a shoe, but we know that those shoes on the next day of work are going to be completed. The assembly line is going to start back up, and those partially completed shoes are going to be complete. So it's legitimate to assume that those costs are not lost. They have value. Whereas under quitting concern, a partially completed shoe probably is going to have to be thrown away. And so if we were producing financial statements using a quitting concern approach or assumption, we would have to write those partially completed shoes down to zero and show a loss related to those. The periodicity assumption says that the economic life of the entity can be divided into artificial time periods that are shorter than its life. Now, we think it's legitimate. We take it as legitimate that we have a first day of a fiscal year. For many companies, it's a calendar year, so it starts at January 1, ends on December 31, and that we start accumulating revenues and expenses at the beginning of the year, and then at the end of the year, we will close revenues and expenses out. Those are temporary accounts. Close them out to permanent accounts, and then including retained earnings, or specifically retained earnings, and the next year start all over again. Well, we accept that as being the case, but in fact, we know that the company doesn't necessarily know that its life is being cut into those into those parts. We do this. We separate the company's life into these artificial time periods so that we can produce financial statements that allow comparability. If we produced a single financial statement that, say, covered 10 years, or the period from the start of the company's inception, then we really wouldn't have those sub-periods that would allow us to make comparisons. Monetary units, as financial data is measured in nominal, that is not price level or inflation-adjusted dollars. Only in rare circumstances are firms required to provide inflation-adjusted financial data. We have to realize that the numbers that we look at fail to recognize inflation over the life of the asset. For instance, that piece of property that the company bought in Atlanta or outside Atlanta for $100,000 20 years ago if it's worth $5 million now, we would have to assume that some of that value is probably related simply to inflation. That is, the decline in value of the currency. A large part of it would certainly be related to simply changes in market dynamics, that is, supply and demand. But we need to realize that financial statements do not generally reflect changes in price levels. Nominal dollars here simply means that we disregard any change in values that might be the result of inflation. We don't try to carve that out as a distinctive element. Two basic assumptions are built on, or concepts, are built under these assumptions: financial position and changes in financial position. And these concepts are expressed in the elements of the financial statements. Now, let's talk about recognition, measurement, and disclosure principles. We've talked about assumptions. Now, here are some principles that are part of our framework. In general, an item should be recognized. That really means recorded when it meets 4 criteria. When the item meets the definition of an element of the financial statements, and remember those are assets, liabilities, equity, revenues, expenses, gains and losses, and these other items that we'll deal with later, these other few items. Measurability, the item can be measured with sufficient reliability. We'll see some occasions later where we might, for instance, have what's called a contingent liability, maybe a lawsuit that we could possibly lose. But we will apply different rules, different procedures for accounting for that event, depending on whether we can, with some measure of accuracy, whether or not with some measure of accuracy we determine what the liability or loss is going to be. Relevance is that says that the information can make a difference in users' decisions. We've dealt with that before. Decision usefulness is a biggie. And reliability, the information is representationally faithful, verifiable, and neutral. Keep in mind, as I said earlier, that when relevance and reliability go head-to-head in accounting, reliability usually wins. That is, that for instance, in the assets, that the cost of a piece of land, how much the company paid for it, what it gave up in exchange for it, is much more easily determinable than what it's worth. The company, if you're thinking about investing in a company, what its assets are worth is really more than what it paid for them. But generally speaking, we're more comfortable with reliable information, even if we sacrifice some measure of relevance. Recognition. Recognition is a concept that concerns both what is to be recorded and when it's to be recorded. The revenue recognition principle states that revenue is recognized only when it is both,